What's happened to the price of Bitcoin? Have the projections of the SP 500 and the dollar index been fulfilled? The reality of the Fed's pivot? What does Jerome Powell have to say on the matter? Stay until the end to find out. Welcome to our weekly analysis. Looking at the macroeconomic situation, CBDCs continue to progress. The FAANG stock doesn't seem promising. The Fed is knocking the market down, yet another week of important PMI developments. Moreover, the Eurozone's GDP, the decision on interest rates in the United States, and much more. We're in for a ride. If you'd like to learn more about blockchain technology and understand the crypto environment and macroeconomics, follow us on Twitter at Mundocrypto_EN. Also, check out our website news.mundocrypto.com for further news. Let's kick off with the technical analysis. In this daily time frame, we can see the upward movement that we discussed in our previous analysis. After reaching the downward line just above $19,700 zone, the price has moved into a consolidation phase where its value started to oscillate between $20,000 and $21,000, forming the next consolidation range. This structure is causing the price to remain in the $20,500 area. Following the move to the upside, we can see that between October 26th and 29th, a small divergence formed. The price action was looking for a push towards $21,000, but the volume reduced as the days went by. This was a small sign of weakness, as in the relative strength index, we can see how there was no harmony between effort and result, between price action and volume, and a small divergence formed in the RSI. This triggered the next move to the downside between October 30th and November 2nd. On this last day, we saw how Bitcoin recovered volatility. The price opened at $20,500 and attempted to head towards the $21,000 area, but macroeconomic data was the cause of this rapid correction on November 2nd. We'll discuss this shortly. On day 3, a kind of doji candlestick formed, while today it opened with a strong upward movement, looking for the previously mentioned important zone of $20,500 to $20,600. If we zoom into the chart and take a look at the visible range or volume profile, we can see the importance of these levels. As we can see, the price has a very important point of control at $20,400, where we can see how Bitcoin is struggling to stay in that area due to the number of movements taking place. To see a continuation to the upside, we would have to see a bullish full body candlestick, which could form a morning star doji candlestick pattern. We would then see a breakout to the upside, a throwback that would go on to test the next resistance area above $21,600, which extends to $22,600. On the other hand, if the price doesn't consolidate and loses this area, it could gravitate back towards the $19,600 area, and it would go from being a consolidation range to a price distribution range. If the drop were more pronounced, it would move towards the relevant VPOC of the next larger control range at around $19,200. In this chart, we can see the dollar strength index. What we mentioned in the previous analysis has been fulfilled to the T. After reaching the zone of the minor bullish trend line, we can see how the value of the dollar experienced a boost, reaching 111.8 points. Consecutively, it experienced a throwback on November 2nd, opened on the downside and suffered a quick correction that continued its upward movement. A type of minor downtrend line is starting to form, where the price is heading towards the resistance. To see a continuation, that trend line would have to be retested, outperformed, and head towards the upside. On the contrary, to see a move towards the downside, a kind of double top would have to test the 111.8 point area and head towards the minor bullish trend line. In the SP 500 chart, we can see how after falling wedge pattern with a bullish connotation, its technical projection was fulfilled instead of the inverse head and shoulders mentioned previously. Following that boost, it reached approximately 3,900 points, forming a double top, after which it dropped down to 3,700 point area, where it remained above the support. Both in regard to Bitcoin and the dollar index, the 2nd of November is of high importance. The markets opened on the upside. However, following Jerome Powell's statements, the S&P 500 corrected its movements and fell. Shortly, we'll be discussing what the president of the Fed said that has had so much of an impact on the market. Taking a closer look at the chart, today we can see a doji candlestick of indecision, so we must watch out and see what happens when the market opens. Should we see an upward move again, it would lead to a lateralization phase in which the value of the S&P 500 consolidates and moves towards that trendline zone and breaks through that area in search of the 4,000 point zone. If on the other hand it is unable to hold the area it is in, we could see a breakdown accompanied later by a pullback, after which it would go on to test the area of approximately 3,600 points. The S&P 500 could also head towards the top of that bearish channel that is formed, fail to hold it, and then drop down. If you're a fan of this type of content, be sure to like and subscribe. Let's now jump into the fundamental analysis. Let's start with the UK. On November 1st, the nationwide home price index was announced, sitting at 7.2%. Much better than the expected 8.3% and well below the 9.5% of the previous month. This index has been falling significantly since March 2022, representing the weakness in the real estate market, specifically in the mortgage market. That same day, we learned the manufacturing PMI data sitting at 46.2, better than the expected 45.8. However, in general terms, it has dropped consistently since May 2021, down to a 29-month minimum. It is clear that the contraction in the UK's manufacturing sector and economic health is becoming more and more evident. Composite PMI sits at 48.2, 1 point higher than the expected 47.2. The composite PMI measures the level of buying activity by entities in both sectors. A reading below 50 indicates a contraction, and a higher than expected reading should be viewed as positive and bullish in regards to the pound. In terms of services PMI, the current 48.8 is higher than the expected 47.5, down from the previous 50. Interest rate sits at 3% as expected, 0.75 points above the previous. In the Eurozone, IPC data reveals a current all-time high of 10.7% compared to the expected 10.2, a 0.8 point rise compared to the September data. In addition, core inflation has risen from the expected 4.8% to 5%. Inflation seems to see no end. Taking a look at the main factors surrounding the Eurozone inflation, energy is expected to have the highest annual rate in October, 41.9 versus the 40.7 in September, followed by food, alcohol, tobacco, and non-energy industrial goods. The quarterly GDP figure is currently at 0.2%, considerably less than the expected 1% and well below the previous 0.8%. This is a sign that the economy's cooling mentioned in recent weeks is getting closer and closer, and a recession is around the corner. On November 2nd, the manufacturing PMIs of the main countries of the Eurozone has been worse than expected. In Spain, it stands at 44.7, below the expected 47.5, and the previous figure was at 49. In France, the current figure is 47.2, which is lower than expected at 47.4, with the previous one being 47.7. Germany, for its part, sits at 45.1, 0.6 points below the expected, and the previous one sitting at 47.8. As a consequence, Eurozone data saw decreases, sitting at 46.6, which is 0.2 points worse than expected, 2 points worse than the previous 48.6. This data reveals how this cooling is quite present in the manufacturing sector, and that too worse than expected. The index's downtrend continues, which is not ideal for the Eurozone. As for employment rate in the Eurozone, the 6.6 figure is as expected. The 2022 OPEC meeting took place in the Abu Dhabi International Petroleum Conference and Exhibition in the United Arab Emirates. Highlights include Global demand for primary energy is expected to continue to grow in the medium to long term, increasing by a significant 23% by 2045. The world needs to add an average of 2.7 million barrels of oil annually until 2045. Uncertainty and production cuts are the culprits. On the other hand, all forms of energy are needed to address future energy needs. In the document World Oil Outlook 2022, presented at the conference, OPEC estimates that the world oil industry will need investments worth $12.1 trillion between now and 2045 to be able to cover the increase in demand for black gold and therefore avoid a supply crisis. These figures, and above all the forecasts, are not at all encouraging. And onto the United States, the most important data of the week is surrounding the Federal Reserve's interest rate decision. The Fed has continued its plans and has raised interest rates by 75 basis points, something that was already expected by the market. According to this data, it will continue with its roadmap with an upcoming rise of at least 50 basis points. However, it could still repeat another 75. The market is equally positioned between one option and the other, as seen in the Fed rate barometer. The same day, the market experienced a boost as this increase of 75 basis points was already discounted in the price. But why did it later drop? This is where Jerome Powell's statements come into play. Here's what stood out from his appearance. Expect consumer spending to be low. The housing market has slowed down, the job market is still strong, and wage pressures are high. The longer it takes to reach the inflation target, the easier it will be to set high expectations. He discussed the impact of inflation on people's day-to-day lives and maintains his goal of reaching 2%, increased 75 basis points, and balance of debt required by the Fed continues to decrease. The level they hope to raise is going to be higher than expected. By this, he meant that the economic projections for September fell short, but he did not make it clear whether he means this year or 2023. Hence, in the Fed barometer seen previously, the market saw a rise of 0.75 as well as 0.5. Shortly after, the market automatically lost all gains. Why? Well, these projections for 2023 could be 4.5 or 5%, and he stressed that the Fed's pivot is not yet closed, causing the continuation of the fall. Sounds familiar, right? This is something we discussed a couple of weeks ago in our analysis and also brought up in our previous one. The message is clear. The hawkish stance is here to stay, and he once again mentioned his fight against inflation at the expense of the housing and labor market. If we go overboard, he said, we can take measures for the economy, but if we allow inflation to run out of control, it will consolidate the economy and will have a huge cost for the people with less economic resources. On November 1st, the manufacturing PMI data was revealed, sitting at 50.4% compared to 49.9% forecast. It has risen by 0.5 points compared to the previous one. These are better than expected figures, which helps in the short term, although the reality is that since August 2021, we have seen a contraction in activity. Based on this latest data, US manufacturing companies reported a slight improvement in operating conditions in October. Expectations for the next year involve the slowest employment growth in more than 2 years. Meanwhile, the inflation rates of input prices and output charges eased once again. ISM manufacturing PMI data is similar to that of S&P Global, 50.2% above the expected 50 and below the previous 50.9, which is also better than expected. This figure indicates the expansion of the economy in general for the 29th consecutive month, depending on how that indicator is seen following the contraction of April and May 2020. But it shows something similar to that of S&P Global, as it has been decreasing since December 2021. In terms of employment, the JOLST survey of vacancies and labour turnover released on November 1st reveals that the number of job offers increased to 10.7 million, above the expected 10 million figure and higher than the previous 10.2 million. As for employment benefit requests, the figure stands at 217,000, less than the 220,000 expected. In short, in the United Kingdom, the house price index is experiencing a significant fall, creating a dent in the real estate market and mortgages. The PMI has a better than expected short-term figure, but in reality, the economy's contraction continues. Rates have been aggressively raised after seeing that inflation continues to skyrocket. In the Eurozone, the data is even worse. Manufacturing PMIs continue to plummet, which doesn't favor the Eurozone, although unemployment rate seems to be stabilizing, giving some room to central banks. But let's not forget that quantitative tightening has not yet started and is falling behind in raising rates, which is why inflation is going from peak to peak. In the United States, the PMIs are better than expected, although they are contracting more and more. These indicators continue to display a slight expansion in the short term. The labor market remains strong and in full employment, and the real estate market is suffering from a rise in interest rates, but it is a market that was overheated. All of this is encouraging its hawkish position. In fact, in Powell's press conference, he once again made it very clear that his fight is against inflation, although at the expense of the real estate and labor market. Furthermore, Jerome Powell had already mentioned that although rate hikes are slower, they're not going to stop selling government debt bonds, therefore reducing their balance sheets. From what we have discussed in this analysis and in the previous ones, the question in mind is, what would happen if all central banks reduce their balance sheets while the rate hikes continue? The ECB has already raised it, the BOE has already done so too, and the Fed is as well. It doesn't seem quite positive. The global recession seems imminent. Will we see a sovereign debt crisis? As you can see, the Mundocrypto analysis provides information and value. Follow us on our Discord channel for more content of this style. Time to move on to the on-chain analysis. This metric displays the volume going out of exchanges is prevailing, and certainly outflows are also prevailing. But we can see that in the short term, these movements of entry tend to lead to a possible price redirection. So watch out in the short term. From October 31st to November 2nd, there were more entries, although they are still minor. And we can see that on day 3, there's an increase in exits. We must pay attention to see if there's any further entries or exits. Now, if we take a look at financing rates of all exchanges, we can see that it is positive, which is normal as it equates prices with the spot market in which sales have prevailed. It isn't a high financing rate, but we see how it increased on November 3rd, sitting at 0.0055%. At the opening of November 4th, it continued to remain positive at 0.0044%. If we take a look at the ratio of longs to shorts on November 2nd, it was leaning towards the shorts, but on November 3rd, long positions in perpetual futures are slightly higher at 52% versus 48%. On November 4th, we can see how the dominance of long positions has been increasing, standing at 56%, while short positions remained at 44%. Bearing in mind that on November 3rd and 4th, those long positions increased in the $20,000 to $20,100 zone. This is where the largest liquidity clusters are found in a very short term, and in terms of shorts, in the $20,800 zone, losing or winning any of these zones can cause stop limit liquidations or price liquidation. This is extendable to 21,000 and below 19,700 in the medium term. If we look at the total liquidations, we can see that it has been practically flat. Some small liquidations, especially in longs on November 2nd, but on November 3rd, not much. Today, November 4th, we can see a slight increase in short liquidations due to this initial movement of the day, but nothing relevant since the important clusters are found in the prices mentioned above. Looking at whale outflows, we can see that these areas are highly relevant, and important movements took place between October 31st and November 2nd. On the 31st, they took the opportunity to withdraw profits from bitcoins bought long ago. As we can see in these smaller circles, on November 1st, they practically broke even from those accumulated in June and September. And on November 2nd, something similar occurred, but with those obtained mostly in July. If we look at the realized price, which is the average price at which current unspent bitcoins were bought, we can see that it's in the 21,080 zone, right where the price has stopped, which is an area of high importance for price action. Looking at the heat map, we can see a bullish movement earlier in the day. According to order books, the most important zone of limit orders is short positions in the zone of $21,000. Underneath, at roughly $20,100, is the most important part of limit orders on long positions. If this area is lost, there are limit orders involved, but where they are positioned the most is in the $19,000 area. Here we can see the limit orders that are positioning and compacting the price. We can see the same thing once again. Short-term positions are in the $20,700 to $20,800 area. Underneath, positions are at $20,400 to $20,500, these being the most relevant short-term areas. We want to emphasize the importance of this, which is what's been impacting the price of Bitcoin. On the blue line, we can see the CVDs in the derivatives market, while the green line represents the CVDs in the futures market. Basically, this cumulative delta volume displays the complete dynamics in the balances of purchases and sales in the market at a certain moment in time. If you look closely, from mid-August, these two lines begin to separate. In the spot, we see an accumulation of delta sales volume, while in the derivatives market, the accumulation of purchases is more rewarded. If we zoom in on the chart, we can see how right now it's correlated with a small increase in cumulative spot and futures delta volume. We can also see how liquidations are flat right now. It would be nice to see the spot market increase this CVD so that the price of Bitcoin headed to the upside. With this in mind, will Bitcoin follow the inertia of traditional markets, or will it disassociate itself from the indices? Is the recession really around the corner? Let us know in the comment section below.